With over 20 years of combined experience, we're going to show you exactly how to start investing in 2025 using 5 proven methods. Whether you're starting with $100 or $10,000, the key is to choose the right strategy for your goals and risk tolerance. To make this real, we invested $100 into each method 4 years ago. And now we're breaking down the results. But before we dive into the methods, here's how we're going to assess each one. Learning curve. How easy is it to get started? Passive income potential? Will it pay you ongoing cash flow? Tax efficiency? How are gains in income taxed? Risk? How volatile is the investment? Results. What would $100 invested 4 years ago be worth today? Let's get started. Method 1. Individual stocks. When you invest in individual stocks, you're selecting specific companies you believe will grow over time. Think Tesla, Nvidia, Apple, or Microsoft. Businesses with strong brands and solid performance. The idea is to identify winners and ride their growth. However, the risk lies in poor selection. Not every company performs the same. For example, Nvidia surged over 850% in the last 4 years. Apple and Microsoft also more than doubled in value. But Samsung, despite being a well-known global brand, actually declined in value over that same period. This shows that even recognizable companies can underperform, making individual stock selection a high-risk, high-reward strategy. In our example, we invested $100 into Samsung 4 years ago. Today, it would be worth just $70. In contrast, that same investment in Nvidia would be worth over $850. Apple and Microsoft would have brought your investment to around $200 to $250. This contrast shows how picking the right individual stock can lead to huge gains or disappointing losses, making research and selection absolutely critical. Here's how investing individual stocks stack up across our 5 categories. Learning curve. Medium requires research into individual companies. Passive income, low, unless dividend stocks are included. Tax efficiency, varies. Capital gains apply, depends on your country. Risk, high. Stock-specific risk and sector volatility. Result. On a $100 investment, we got $70 to $850 depending on stock selection. Method 2. Real estate investment trusts, REITs. REITs let you invest in property without buying a house. They pay dividends and tend to perform well in stable economies. Real estate investment trusts, or REITs, allow you to invest in commercial and residential property markets without owning physical property. You can buy them through ETFs like VNQ on most brokerage platforms. They're especially appealing for those looking for regular income, as REITs are legally required to pay out most of their profits as dividends. If you had invested $100 into a REIT ETF like VNQ 4 years ago, your investment would be worth around $120 today. Plus, you would have received approximately $12 in dividends. This shows modest growth and consistent cash flow, making REITs a stable option for income-focused investors. Here's how REITs stack up across our 5 categories. Learning curve. Low. REIT ETFs are easy to access. Passive income, high, consistent dividend payouts. Tax efficiency, moderate, dividends are often taxed as income. Risk, medium, linked to real estate cycles and interest rates. Result, around $130 to $135 total return. Method 3, cryptocurrency. Bitcoin is the most well-known crypto and one of the most volatile assets. To invest in crypto, you'll first need to set up a digital wallet. This is where your crypto is stored and managed. Wallets can be software-based, like MetaMask or Trust Wallet, or hardware-based for added security, like Ledger or Tangem. Once your wallet is ready, you'll use a cryptocurrency exchange to purchase assets. Popular platforms include Coinbase, Binance, Blowfin, and Bybit. These allow you to buy Bitcoin, Ethereum, and other altcoins using dollars or euros. After purchase, it's recommended to transfer your assets from the exchange to your wallet for safekeeping. Investing in crypto requires attention to security, private key management, and understanding blockchain networks. While the learning curve is high, the growth potential has historically been substantial. If you had invested $100 in Bitcoin 4 years ago, it would now be worth over $550, despite dropping over 70% at one point. Here's how crypto investing stacks up across our 5 categories. Learning curve. High requires understanding wallets, exchanges, and security. Passive income. Low, unless you stake or use DeFi, which is a topic for another video. Tax efficiency. Low. Capital gains typically apply, varies by country. Risk. Very high, extremely volatile but potentially high reward. Result: $400 to $600 from a $100 investment. Method 4. Gold. Gold is a classic store of value, especially during inflation or uncertainty. A $100 investment in gold 4 years ago would now be worth around $170 to $180. You can access gold through ETFs like GLD, which track the gold price and are easy to buy on brokerage platforms. Alternatively, physical gold can be bought via coins or bars through certified dealers, though storage, insurance, and authenticity checks are important. Here's how investing in gold stack up across our 5 categories. Learning curve. Low. Simple to buy and hold. Passive income. None. Gold doesn't pay dividends. Tax efficiency. Moderate. Taxed as a collectible in some countries. Exemptions apply in others. Risk. Low. Relatively stable. Result: around $180 from a $100 investment. Method 5. Index funds. Let's use the S&P 500 in our portfolio. The S&P 500 tracks the top 500 companies in America. This means you're investing in a broad range of large-cap companies like Apple, Amazon, and Google, but without picking individual stocks. This distinction is key because index investing spreads risk across many companies, whereas buying individual stocks concentrates risk in just a few. It's a favorite for long-term investors because it's diversified and historically strong. If you had invested $100 into an S&P 500 ETF like SPY 4 years ago, you'd now have around $160, a 60% return, averaging 12% annually. Here's how index funds stack up across our 5 categories. Learning curve. Low. Easy to invest through ETFs. Passive income. Low to moderate. Some ETFs pay dividends. Tax efficiency. Moderate. Long-term capital gains rules apply. Risk. Low to medium. Reflects overall market trends. Result: around $160 from a $100 investment. So, which method is best? Here's the breakdown. Individual stocks. Negative 30% to 850%. High risk, high reward. REITs. 30% to 40% return. Good for diversification and income. Crypto, 500% plus, highest risk and potential return. Gold, 70% to 80%, stable and protective. S&P 500, 60%. Steady growth with low to moderate risk. No single method fits everyone. That's why smart investors blend them, building a portfolio that matches their risk, goals, and time horizon. Here's a simple split to start with. 50% S&P 500, 20% individual stocks, 10% crypto, 10% REITs, 10% gold. This gives you balance, growth, income, and long-term stability. Want to go deeper? Subscribe to the channel, where we decode the world's most successful systems and help you build your edge one trade or investment at a time.